All right, so we're going to go ahead and get started. So qualified plans and life insurance. My name is Art Valdez, and I am the CEO of Global American Financial Brokerage. The IRS is your silent partner in retirement, agree? And Uncle Sam wants as much as 40% of your retirement dollars, assuming that things stay the same. Some less, but some people may be paying up to 40% of the retirement dollar. So retirement assets total $28 trillion in the United States right now. Did you know that, Harry? $28 trillion according to first quarter of 2018, and this is retirement assets, right? So how is that broken down? Well, in 2018, annuities are $2.2 trillion. Government defined benefit plans are 5.9. Private sector defined benefit plans, 3.1 trillion. Defined contribution plans are 7.7 and IRAs are $9.2 trillion. So a lot of folks are sending their clients to get IRAs. Does that ever happen? Most of us, yes, absolutely. Everybody, you want to save a little bit of money. Harry, have you ever told somebody, go get an IRA, save a little bit of dollars? Yeah, we all do, and there's $9.2 trillion, right? So retirement assets by type, right? And this is from 17 to 18, and it's been pretty consistent. It might have dropped a little bit in the IRAs, defined contribution plans, private sector. And so you notice that there's a little bit of a drop in contributions, and more people are becoming aware of the taxes, where we're headed with taxes. Because right now the taxes are at all-time low, and we're going to talk a little bit more about that. So 2017 to 2018 taxes, right? Everybody has made a big to-do about the tax changes and how much money it's going to save you. So single, 2017 versus 2018. If you are making 9 to 37,000, it was 932 plus 15%, 952 plus 12%. So there's a savings there, right? If you look at the people that are making over $500,000, is 121 plus 39 or 150 plus 37. So it depends how much money you're making, whether it's really a savings or not, right? And as I was doing this presentation in Amarillo not too long ago with a bunch of tax advisors, they were telling some people are going to get a cut, some people are not going to get a cut, in 2018, right? And married, filing jointly, the same thing, right? Over 470,000 is 131 plus 39. Over 600,000 is 161 plus 37, right? So the jury's still out how much each different class is going to save, but definitely going to be savings. Now, the key here is in January of 2026, it's going to revert back to the old taxes. Yes? It's a sunset bill. So how is it going to impact? It's going to impact estate plans, right? It went from 11 million, it could go back to 5.5 million or maybe 600,000. We don't know that yet, what it's going to go back to. But everything is going to go back. So that said, is right now the taxes are as low as they've ever been, but they're going to go up. So the question continues to be, Harry, is deferring the tax the best option? So we're gonna continue to see that. And what do we do with clients that already have a lot of money deferred, right? So question, will future tax rates likely be lower, the same, or higher? Andrew, what do you think?
Higher.
Higher. Harry, what do you think of future tax rates?
Should be higher.
Should be higher, right? Would anybody say it's going to be lower or the same? Should be higher. So now we're telling our clients, save taxes now and pay taxes in the future, but if taxes are going to be higher, is that the right decision, right? And I'm not saying one way or the other, just asking the question. So is postponing taxes really the best idea, right? Your IRA, your pension, your 401k will be taxable at retirement, perhaps at a higher rate. Agree? So no matter how much, if you're making 25% on your returns, if your tax increases by 25%, it's a wash, right? So the other thing that concerns a lot of folks is Social Security. Did you know that up to 85% of Social Security income can be taxed if you're above a certain tax threshold? And so, but there's also a way to avoid paying taxes if you start bringing out the qualified plans before you reach the RMD, okay? And there's a lot of studies on that. If you start at 59 and a half, start emptying out your qualified plan. And so when you're 70 and a half and you start getting the distribution, because your Social Security tax could be $5,000, $6,000, $8,000 a year. All right? So there's a way to do that, and that's where we're going. Because let's just think about it. When you are in the tax services, a CPA, you're mainly concerned about saving your client's taxes right now. Am I correct? So how about the distribution? How about if we can do it on both sides? So now I'm going to talk a little bit about the debt. Andrew, have you seen this before?
I actually have.
Yes. Harry? This is the U.S. Debt clock. Right now, the U.S. national debt is $21 trillion. Remember there was a big to-do when it hit 20 trillion a few months ago? It's at 21 trillion. So presently, the U.S. federal tax revenue is 3 trillion, right? So we're not bringing in nearly as much as we owe. The heavy spending happens on certain things here. For example, Medicare is 1 trillion. Social Security, almost 1 trillion. Defense, 616 billion. Income security, interest on the debt is 306 trillion, right? And the federal pension is $261 trillion every year, right? Those are the heavy ticket items. So right now, we are not moving in the right direction with our debt. We're going more and more and more in debt. So logically, it is fair to say that somewhere along the line, we're going to have to pay for this debt. Would you agree or disagree? And would you say that taxes might be involved with that, Rodolfo?
Potentially, yeah.
Potentially, right? So do we need to prepare our clients for that? And the reason I'm showing you this is because it is really important that we're aware of where we are moving our clients, right? Harry, all of this information, I went to a CPA symposium in Las Vegas, and they were talking a lot about this, right? The other thing they were talking about is CPA firms. A lot of them, do you do audits, Harry? Do you do any audits? No. Audits are getting automated a lot, so it's getting to be less. And so also millennials are doing more in their phones, right? So they're doing a lot of taxes. So it's only the big companies that are, or the big business owners that are going to CPAs. So Harry, today might be, David, Kobe, today might be the day that changes everything for your clients and for your firm as well. So options for qualified plans. Now we're getting to the meat and potatoes, you know, even though you guys are already in the dessert, right? This is the meat and potatoes. So right now, when the distribution is made from a qualified plan and you are before the age of 59 and a half, there's a 10% penalty plus ordinary income tax, yes? Now, if you're 59 and a half, it's just ordinary income tax. However, the key is this: some people may not need the money, but Uncle Sam says, we want our money. And at 70 and a half, you're going to be required to pull out some money. You have some clients that are there? Most of my clients don't like that because they say, that's not the money, I wasn't planning to use it, but now I'm forced to pull it out and I'm paying a lot of taxes. And if you don't pull it out, guess what? They penalize you on 50% of the money that you were going to get out. So if you're going to get out $10, Uncle Sam keeps $5 for not pulling it out. Am I correct, Harry? Yeah. So those are the distributions. So that applies to every single qualified plan, 403B, 401k, 457, everything. So, distribution to beneficiaries. If the owner of the qualified plan dies, spousal rollover. The surviving spouse is treated as the owner. So there's no taxes there. It just goes straight to them, right? Surviving spouse can name new beneficiaries, which are their kids, right? Perhaps. And it also can stretch the time of you paying taxes. However, Uncle Sam right now says we need money now. Have you felt that urgency? They're doing that. So we used to have stretch IRAs that go generations, from this generation to the grandkids. Not anymore. You see, the legislative updates of 17, 16, 15, and 14 says that the payments must be made to the beneficiary within 5 years. And we've had some cases where people are moving their money to annuities where they have to start taking income right away and get a distribution within 5 years. So now they're getting money in addition to their income. And if they're at the highest earning levels, it throws them to a different tax bracket. So let's just say they were getting $100,000, but they get another $50,000 a year from this distribution. Now you're paying tax on $150,000. Let me ask you, Harry, would that change tax bracket for you if you go from $100 to $150,000? Yes, it's possible, absolutely. So this is really important to know because the proposal, which raises $6 billion of new revenue, is effective after the 31st of 2016. Okay? That's the important stuff to know. And if you need to learn more, go to this website. I was in there all morning. Whew, man, TMI. More than you can probably digest. So, Roth conversions, should you? Will your client's tax bracket be higher or lower in the future? Well, will the income tax be replaced by sales, flat tax, right? Other taxes? Do you want to delay your distribution beyond? So, training it to a Roth might be an option, right? However, I'm going to show you in a little while true numbers, actual numbers. Here we go. First example, Harry, and if you have a client that has a large IRA or a large, right? So you can move that money into a specific life insurance policy that is that is within the pre-tax dollars, right? So you are putting in money in there. At the end of 5 years, it is through Section 79 of the IRS code. At the end of 5 years, you pull that policy out, pay the taxes, and then from then it becomes everything tax-free. You're gonna love this thing. When I was at the CPA symposium, this right here created a roar. A CPA that I was with said, Art, this right here is worth the price of admission because it is so powerful. And let me show you how much money you're gonna save your client. So, if you're a business owner, you have $1 million and you pull out the money, you're going to have $600,000 left. $400,000 goes to taxes at the highest tax bracket, close to it, right? Rounded it up. If you move it to that insurance and you pass away, your heirs are going to get $3 million. Where would the family be better off? With it $600,000 or $3 million? Now, here's the deal. Is the distribution solution alternative? if you pay the $1 million premium, $1 million into the life policy, the market value at the end of 5 years would be $741,000. So you will only pay taxes on $741 instead of $1 million, saving you $103,000 in taxes. Would that help your client? And the way we did this, Harry, is these taxes, we rolled them into a loan in the policy, so it doesn't even come out of pocket. So they don't even do that out of pocket. But they're saving 25.8% in taxes by doing that. Okay? So in a synopsis, if you do the insurance, your client is paying $323,000 and never goes up, right? That's one-time lump sum, that's what they paid. If you're taking distributions at age 75, you paid $1 million in taxes already. At age 80, you paid $1.2 million in taxes. And at age 85, $1.4 million in taxes. So let me ask you, where would you rather your client be? Have paid $300,000 or $1 million in taxes, right? And that's by deferring. So the reason you're able to do this is because after February 12, 2004, there's a fair market value in the IRS code for a policy coming from qualified to non-qualified. So a policy has expenses, right? And this policy is specially designed for the Section 79 of the IRS code. What it does is the policy expenses are usually divided into 10 years or 15 years in most policies. This policy, it is divided into 5 years. So at the end of 5 years, all expense charges are finalized. So that is where your client has the least amount of cash value that he will ever have. And so when you're pulling it out, you're only paying money kind of in the cash value, right? So your $1 million became $750,000 cash value. You pull it out, you pay taxes on that, and then it grows tax deferred, you pull it out tax-free, and I'm gonna show you what that does. Not only that, but tax-free death benefit is always there, right? Tax-free income from the policies is always there. No additional costs, living benefits. We're gonna talk a little bit about living benefits. So here's your life insurance. So your client is 55. You have $1 million. First year at 55, we're trying to get the money out before 70 and a half, right? Pays $200,000 into the policy. The balance is $800,000. The death benefit is $3 million. If your client dies at that time, their family gets $3 million tax-free. And they have $800,000 still left because a policy will pay out from the initial premium. Year 2, another $200,000. Year 3, another, and there's the cash value in the life insurance, right? At the end of year 5, you put in $1 million, your cash value is $741,000. There's still a little bit of money left because it continues to get interest, and we set a 5% interest. So you're gonna pull that out and you're gonna pay $26,000 on that money, leaving a net $40,000. So at the end of 5 years, you wiped out the whole fund. You have a $3 million death benefit, and your cash value is $741,000. So now it starts to build. Even at 5%, at age 65, your cash value is almost back to $1 million. Your death benefit is still at $3 million. At age 70, when your requirement distribution was supposed to kick in, $1.3 million of cash. So you can start getting income if you want to, and it's tax-free income. Anything you pull out here is going to come to you income tax-free. It's taken out as a loan. The living benefits are taken out also tax-free. And if you just want to transfer the wealth and you die at age 90, you're transferring $4 million to your heirs tax-free because all life insurance death benefit is paid tax-free. Is this helping process some of the things that we do? So if you had an IRA, now we're going to do an exact comparison, right? And if you died, your family is going to get $600,000 versus $3 million, right? If you die at age 59, your family is getting $729,000, assuming the 5% return, right? So if you look past this, your income, right, after tax, you ended up with $1.4 million out of an IRA because of taxes. If we go back to this one, it goes way beyond 1.4 million and it's tax-free. Okay? Let's go to a Roth IRA. We talked about converting it. Should we convert it or not? Well, in this particular scenario, if you were to convert it at age 55 or whatever age you want to convert it, you still have the tax happening right now when you convert it. And it grows at the same 5%, but your total income coming out of there is going to be 1.3 million versus if you don't roll it, it's 1.4, or if you turn it into a life at $3 million. So the client wins by getting a little bit creative with how we're going to distribute the income. Kobe, we're with me here? So here is a comparison. Total insurance after taxes at age 75, 2.3 million. Qualified money after tax benefit 1.3, Roth conversion 1.2, death benefit 3 million, right? And if you go down here, and if you live to be 95, 2.5 million in cash, your death benefit is almost $6 million, right? So it is super important that we as CPA start talking to clients about the distribution facet, right? So I'm super busy. I don't have time for this. I work 100 hours every week during the rush hour, right? A lot of CPAs would say that, right? Well, here's the deal. I want to tell you in a little bit. If you're going to save your client $143,000 in taxes and get him more income tax-free, is it worth the effort? Furthermore, what is it in for me? What is the business proposal? So Harry, if you have one client like this, you don't have to know life products. That's where GAF comes in. We have this, and there's only a couple of policies that you can use that are friendly to Section 79 of the IRS code, right? So all you got to do is say, have Rodolfo talk to him, right? Or let me talk to him, or one of your agents. So GAF, we have a third-party administrator that does all the IRS reporting, because every year the IRS has to have a report on this transaction, right? So the TPA takes 20% cut of the commission. So your commission, without doing anything, just saying, Rodolfo, take care of my client, would be $50,000 with one client. Would that help? Now, if you're a licensed agent, Harry, are you an insurance licensed agent as well? Or no, not yet? You have. So then if you do it all, your commission will be double, because that's assuming that you're doing a split sale with GAF. Well, you don't have to. You just get appointed through GAF, and we'll help you with it, right? And then your commission would be more. Fair? So you can double that. Would that be a good day at the office? Mm-hmm. So what if you can do 2 or 3 of those a year? That would help, right? And you're helping clients tremendously by saving them a lot of money in taxes. So the living benefit. Let's talk about the living benefits, because it's more expensive to get sick and live than to die. But if you live, you're a burden. You're a pain. Somebody's got to take care of you, and then all that costs money. There was a guy at the last seminar we were doing, he said, my kids are going to take care of me. Yeah, right. So they're not going to go to work, and they're not going to have a life because they're taking care of you? I don't think so. So living benefits are critical. At age 57 on this particular policy, if the client was going to say, I'm terminal, the doctor says, you know what, go visit your long lost brother because you got 24 months or less to live, they could get a $1.5 million lump sum, and they still have 1.5 million death benefit because it was a $3 million policy. The cap is 1.5 million. If they have a chronic illness, you're going to see what it means in a little bit, but they would get up to $3,000 per month because it's the IRS max allowable. Whatever the IRS max allowable is what it is. And you get this for 50 months, which equals $1.5 million, and then it stops. Or you can get half of that, $15,000, for 100 months, as long as it doesn't exceed the IRS maximum. So would that get you into a pretty decent assisted living?
Of course.
Absolutely. Critical illness, up to $1 million lump sum. Critical injury, and let's look at what that is. Terminal. Kobe, can you read that one, please?
Terminally ill means that the insured has been certified by a physician as having an illness or chronic condition which can reasonably be expected to result in death in 24 months or less. There is no premium for this rider.
So if the doctor says, Harry, got 24 months or less, you can access this money. And let me tell you, there's a lot of testimonials, and if you go to the website of this company, and I'll tell you more about it in a little bit, of people that have lived because of this. There's experimental treatments in Canada or other countries, Europe, Germany, Mexico, that their insurance doesn't cover. So you can use this money to go treat yourself, give you another chance at life, right? Chronic, God bless you many times. Chronic illness. So chronically ill means, Catherine,
Chronically ill means that the insured has been certified by a licensed healthcare practitioner as being unable to perform 2 out of the 6 activities of the daily living or is cognitively impaired. The activities of daily living are bathing, continence, dressing, eating, toileting, and transporting. There is no premium for this rider.
so they don't charge you for this rider. This, by the way, is the same qualifications for long-term care when you don't perform 2 of the 6 activities of daily living. And they're gonna give you up to $1.5 million. Phenomenal. Additionally, they have, this is my favorite living benefit of it all, because God forbid, right? Let's just say, Harry, are you the main breadwinner in your family? So God forbid, but you see you have a heart attack and you can't work for 24 months. You have to learn to walk and talk again. Would that affect your bottom line if you could not work for 24 months? Yes. So what this does, they advance you the death benefit so you can pay your mortgage and continue to live while you're getting well. So you only have to focus on getting healthy. How powerful is that? And there's not many companies that do that, but this one is the best. So the qualifying events, Harry, you wanna read that one? The qualifying events, please.
With the qualifying events, graft surgery, plastic anemia, blindness, cancer, cystic fibrosis, diagnosis of ALS, end-stage renal failure, heart attack, heart valve replacement, major organ transplant, motor neuron disease, stroke, and sudden cardiac arrest.
And there's no premium for the rider. So have you heard of anybody that has any kind of this happen to their life? Well, if you put your client in this, they have access to this. In addition, if they fall off the roof of the house and are in coma, paralysis, burns, or traumatic brain injury, it also covers that. So imagine having up to $1 million for that family to take care of themselves. So what if they just decide to invest instead? They say, no, we're not going to take the alternative, right? So the performance may be better or may be worse. I've had people tell me, I can do better in the market. So if you're making 15, 20% of the market every year and you're in a qualified plan, and then when you retire, you're at a 50% tax bracket, in all these plans, you are growing without risk over the downside, right? And then clients take market risk. When the market goes down, whew, you take a beating, right? And, negative returns. So that is one negative thing if you invest, right? You might make a lot of money, but you might pay more taxes, etc. Taxation upon distribution from IRAs. Future taxes, we kind of consensus here that they're going to be higher the next 30, 40 years and require RMD. No insurance features, no living benefits, none of that. So if you just keep your money in the market, you have all of these possibilities, right? So does it make sense to explore a policy with all the living benefits, with all the tax benefits? And so here is, let's talk about the impact on taxes, right? If you don't have the insurance, you have taxable interest, 18,000, and then the exempt, 10,000, and then you have Social Security, 45,000. 38 of those are taxable because 85% is taxable, right? And if you multiply that times 85%, and then pensions and annuities, 140,000. So your taxable income is 196,000. Taxes due is 36,000. Okay? By the way, this was done by a CPA, so it's accurate. So what if you take the life insurance and you're getting a loan, tax-free loan, instead of, you still have the 18,000, but the IRA distribution is tax-free. Same 140,000. So your Social Security benefits is only taxed, you only get taxed 11,000 out of that, for a total of 623,000 in total taxes due. So as a financial professional, where do you want to tell your client to be? Here or here? By the way, if it's here, you keep doing what you're doing. If it's here, you made an extra $50,000 or $100,000 in your pocket. And every year you're saving them $35,000 of taxes. If they live 20 years, what's 35,000 times 20 years? $700,000 in taxes you save. You're the hero in the savings right now and also in the distribution part. That's what makes it really exciting. So, distribution solution, life insurance, reduce taxation, eliminate the requirement minimum distribution, tax-free death benefit, potential tax-free income if you get it as loans, and policy index strategies. I'm going to show you a little bit what indexing does and the living benefits. IRAs, we went through that, right? You can do a Roth conversion, you can do a stretch IRA, delays it for 5 years. Investment risk, if you annuitize, then you give up control. So, do you qualify? Do you have earned income? 401k, profit sharing plan, right? Can you think of one client, Harry, that has a large amount of money in a qualified plan? Yes, right, there's a lot. So that will be qualified. Is minimizing taxation important to them? Is reducing taxes important to them? If the answer is yes. Do you want tax-free income? Are you concerned about the RMDs? Do you have interest in increasing your benefits to your heirs? Instead of 1 million, 3 million, right? Do you have assets or insurance for terminal chronic illness, right? Does your assets cover all the living benefits? And the answer is going to be no. And are you insurable? That is the one question that is huge, okay? Are you insurable? So you got to get them while they're young and healthy, right? And so that's why this example was at 55, because when you turn 59 and a half, boom, you're going to move everything out, right? And that's kind of the deal. So more about this policy. When the market goes up, you make money. When the market goes down, you don't lose money. Have you heard of index products? Yes, so this is an index product. So let's talk a little bit about where people put their money. 401ks, a lot of the qualified plans are in the market. Why, Jose, do you think people put money in the market?
For growing potential.
Growing potential. David, could we lose that money?
Yes.
Do your clients like losing money?
Nobody wants to lose it.
So maybe it's not right for your clients, maybe. So then a lot of people get scared and they put their money in banks and credit unions because it's safe. Richard, what kind of returns do people getting in the bank today?
1%.
1%. So rule of 72, remember that? It takes at 1%,
Yes.
72 years to make $1 into $2. So everybody in this room will be over 100 years old.
Yeah.
So You got to pay taxes on that. Good call there, Jose. So the way to be for most middle America, unless you are, you got money to throw away, is an index account, right? Index has the upside of the market with limitations. And those are called caps. And the caps vary from 2% to 20%, depending on what product. And the floor is guaranteed to be the same as the bank, 0. So you never lose. A little bit of how it works. Let's just say, Harry, you and I are going to put $100,000 into an account, right? First year, the market does 10%. You are an index product, you're at 110. I'm in the market because I have not talked to Rodolfo yet. And so I am at 110 because the market did up. The second year, the market loses 15%. So I was in the market, so I lost almost $20,000. You were in an index product, and guess what? You're at 110. You did not make a penny, but you did not lose a penny. 0 is your hero, right? Next year, the market does 5. You're at 115 because you started where you left off. I have to dig myself out of the hole. Gap of 17. The next year, the market does 20. Well, if I'm in the market, I get all of it. If you're an index product and the cap is 14, you only get 14%, but you're still way ahead. And if you keep running this illustration through the history of the market, the gap gets wider. So indexing gives you the upside of the market without losing. And that's this product right here that I was showing you. So your client will never lose that $1 million. Life event story. Here's just a typical client. And we're doing good on time, yes. Young couple married. They have an 8-year-old son. Their needs is going to be protection in the event of death, illness, and building some cash for an emergency or college or retirement income, right? This is the same product. So they buy $1 million, paying $950 a month on them. This is an after-tax deal. This is just something that you offer your clients, right? You pay premiums on all years except on the years you're withdrawing money or you're getting a benefit, right? So, stage 1 in life, they got $1 million death benefit protection, right? Cash value is deferred. Year 11, kid needs to go to the college, right? So they're going to draw $5,000 a year. So you're probably thinking $5,000 not enough for college. But remember that they don't pay premium. So all of you are math wizards. What is 950 times 12? Right? $11,400. So now they have $5,000 plus $11,400, $16,000 to help the kid go to college. Would that help? Absolutely. Second stage, Mark is diagnosed with multiple sclerosis. Who in this room could have multiple sclerosis? We don't know, anybody. The virus could be in our bodies. So they use the accelerated benefit chronic to replace wages and make home improvements, $40,000 a year for 3 years. Plus $11,000, they're really getting $51,400, right? Because they don't pay whenever they're getting benefits. The third stage is retirement. You can draw income from this policy, and it's got lifetime income payments guaranteed. Once you start drawing, you're guaranteed like a pension, like a defined plan. So they're getting $39,000 a year, lifetime. And because if the market is doing really good, every 5 years it ratchets. It can go up, but never down. So in this particular case, he gets small increases every 5 years. And the final phase, he dies, right? So there's $646,000 left. Beth, the wife, is financially secured, right? And her incomes are met, and she even helps the grandkids with college. So here are the numbers. Harry, you're the CPA. You paid $262,000 in premiums. You took $220,000 for college, $120,000 when he was sick. Lifetime income benefit, the retirement income, $638,000. Death benefit, $646,000 for $1.4 million. If you deduct the premiums, your net benefit is $1.1 million. So would it make sense for somebody to write you a check for $250,000 if you're going to give them $1 million? Would you know somebody that would do that? And the best thing is that the $250,000 is paid in installments over 30 years, right? That's an option. But that's a little bit about the power of this product, right? I just wanted to show you what it can do. In the other case, he was putting $1 million for $3 million in benefit. In this case, they're putting $950 a month for $1 million in benefits. So it can be leveraged high or low, okay? We have clients that are putting in $250,000 a year, and we have clients that are putting in $100 a month, right? So it protects you if you die too soon. Like I said, in the first payment, they pay $200,000, and if they die, the family gets $3 million, tax-free. If they become ill, are the kids gonna take care of them? No, who's gonna change your diaper, right? You can use that money. And if you live too long, you can use that money for income. So coming soon, more CPA CE Lunch and Learns. All financial professionals do a great job on the saving side, but the distribution, I've seen a lot of people left out hanging with a lot of big tax bills. So that's what we want to do, is be able to help CPAs help their families. Global America Financial is an independent financial services firm, and we have agencies that are 800 big or 1 and 2 the size. We have people making 7 figures, and we got people making 30,000. So we can fit any type of agency and be able to pay them well and accommodate. A little bit about us. We are an IMO independent marketing organization. We're nationwide. We're service agents, GAs, MGAs, and FMOs. Okay? Everything is direct pay, lifetime renewals, no captive contracts. You don't have to be captive, no quotas. We have a system for everything. Full company support and training. We're local. And partnering with us, we'll be partnering with one of the premier FMOs in the country, and of course, the best in Texas. Yours truly is CEO, and we are in Dallas. Our office is in Dallas off of Preston. Rodolfo is Vice President for Business Development and Marketing. He does that, Rodolfo. Colby, Field Operations. He'll go out and train agents. And he also oversees contracting. Catherine Rivera, who you saw here, she's the Director of Agent Services. She'll make sure you're contracted. You make sure you get everything you need. So you're gonna get support from everybody up here. So again, very grateful that you're here and enjoy getting to know each other. So at this time, we're just going to adjourn and say thank you.